Tired of the struggle being real? Or maybe it feels like it's real. Do you feel you've been working hard to make your trading work and it's just not coming together? Well, this video is specifically for you, because in today's video, I'm going to show you how to make crazy money trading part-time. And I know that sounds so overly simplified, but that's what I'm going to show you in today's video. So what I would suggest you do is that you get a pen and paper or get a notepad, because there's some learning that's going to take place right now. So it all starts with understanding central bank power plays. That is the first step in your journey to making crazy money trading part-time. It is understanding central bank power plays. Now, when it comes to central bank power plays, it's pretty simple. It's pretty straightforward. What we are looking for central bank divergence. What it essentially means is that we have two central banks that seem to be moving in opposite directions. That is all that we need as the first step for us to actually make our attempts of making crazy money trading part-time become a success. That is the first step, that we need a divergence in central bank monetary policy, right? So let me just go back to this trade that I had on the screen shortly. This is AUD New Zealand. So I've been in this trade since when? Since September. And I added another position, obviously, as you can see that the trade is currently playing out. And this is what I mean when I say that you trade part-time, because I only had to execute positions twice. And after I had the positions actually running, there's no other heavy lifting that I had to do or any other form of physical activity that I had to do. At that point, the market had to work for me. So that is why I say that you trading part-time, obviously you need to do the work beforehand, but you are trading part-time and making crazy money as a result of that. It all starts with understanding central bank divergence. So that is why I have these two central bank statements here. So on the left side, we have the Reserve Bank of Australia. On the right side, we have the Reserve Bank of New Zealand, right? And this is the work that most people are unwilling to do. But it is also the work that actually leads you to success when it comes to trading part-time and obviously making crazy money as a result of that. This is the first step that you need to get good at and understand what is happening, right? So I'm just gonna quickly skim through these statements, right? Obviously, I can't sit here and read the whole statement, but I'm just gonna skim through to give you an idea of what you are predominantly focusing on. Because remember, the key thing that you're trying to establish is a divergence. That is there some sort of pulling in opposite directions when it comes to these two central banks. That's what you're looking for, because if you have a divergence or a clear divergence, then that is when you're gonna get what? Some sort of a trending market. But if you don't have any clear divergence, then that is when you're generally gonna get what? A range bound market or a sideways moving market, right? So let us start with Australia. Obviously we are in a buy position on AUD NZD, but let us just start with Australian Reserve Bank of Australia statement and actually read what they say there, right? Because at the end of the day, what I like to say about central banks is that you need to view central banks as the captain of the ship. And if central banks are the captain of the ship, then it means that they're pretty much in charge of almost everything, right? Yes, they do have people who are maybe working down by the engines, so on and so forth, but at the end of the day, they make the decisions, right? To a certain extent, they make the final call. So that is how we need to view central banks as well. So that means that if we have an idea of what the captain is looking at, thinking about, focusing on, then to a certain extent, we should be able to not predict, but anticipate the possible decision or the next decision they can possibly take, right? That is a very important thing when it comes to central banks. So reading, so this is the statement from the from the meeting that they had on the 5th of November. So at its meeting today, the board decided to leave the cash rate target unchanged at 4.35% and interest rate paid on exchange settlement balances unchanged at 4.25%. So essentially, they held interest rates. They did not cut interest rates, right? Then they continue to say this about inflation. Now, if you're not clear about understanding the relationship between inflation, interest rate expectations, and the different asset classes, then I suggest you watch the video that that's going to pop up on the top right corner, because that video explains in clear, specific terms the relationship between all those three categories that I've just spoken about, which is inflation, interest rate expectations, and the different asset classes. When I say different asset classes, I mean currencies, gold, oil, so on and so forth, right? Stock market indices. That is what I'm talking about. So just watch the video that just popped up on the right top corner, so that you have an understanding of the relationship between those. But if you have an understanding, then you can proceed. So now, let us read on what they said about inflation. So inflation has fallen substantially since the peak in 2022, as higher interest rates have been working to bring aggregate demand and supply closer towards balance. Headline inflation was 2.8% over the year to the September quarter, down from 3.8% over the year to the June quarter. This was expected. Very important thing as well. When you're reading central bank statement, very important that you pay attention. So this is what they said. This was expected due to declines in fuel and electricity prices in the September quarter. But part of this decline reflects temporary cost of living relief. Abstracting from these effects, underlying inflation as represented by the trimmed mean, which is essentially core inflation, and core inflation is the one that I consider to be more important or more significant, because core inflation, unlike headline inflation, which is the one that fell to 2.8 as expected, essentially, and it's just a temporary relief, then core inflation, on the other hand, actually shows us the actual inflation picture of the economy, because headline inflation takes into account energy prices as well as volatile items like food. And you all know that oil prices fluctuate a lot. So if oil prices have been falling, then it means that headline inflation will obviously be falling as well, right? Because headline inflation takes into consideration energy prices as well, but core inflation excludes energy prices. So regardless of what happens with oil prices, what is the inflation from the actual economy? That is, core inflation is a better representation of that. I just wanted to point that out there. So this is what they said. So the trimmed mean was 3.5% over the year to the September quarter. This was as forecast, but is still some way from the 2.5% midpoint of the inflation target. So the inflation target midpoint is 2.5, but the target band is what? It is 2 to 3%, right? That is very important that you understand as well. Like I said, if you're not clear about inflation, the relationship, so on and so forth, watch the video that I suggested, because I explain all of this in that video. So the forecast, and then they continue to say, the forecast published in today's statement on monetary policy do not see inflation returning sustainably to the midpoint of the target until 2026. So now, like I said, you need to pay attention. What are they essentially telling us here? Okay, they're telling us that headline inflation fell to 2.8, but it was something that was expected, and it was obviously a reflection of the temporary cost of living relief. Temporary. Important word there, temporary. Then they secondly told us that core inflation at 3.5%, it was what? It was in essence as forecast, but it is still some way far from the 2.5%. Obviously 1% above the midpoint of the inflation target. And then they continue to tell us, the third point, that they do not see inflation returning sustainably to the midpoint to the midpoint of the target until 2026. So essentially what that means is that we do not forecast or foresee ourselves as the Reserve Bank of Australia cutting interest rates anytime soon. Because if they had confidence that inflation was gonna reach their target in 2025, as an example, maybe let's say beginning or first half or the first quarter of 2025, then it means that they do foresee themselves actually lowering interest rates very soon. But if they're saying that they expect inflation to reach that midpoint in 2026, it's not to say they will only wait until it gets to the midpoint before they start cutting interest rates. No, that's not what I'm saying. But it is just giving you an idea that they based on their analysis, they forecast that it's going to take some time for inflation to fall. That is essentially what we're getting from that, right? Then they continue to say, the forecasts published today are very similar to those published in August. The forecast path for underlying inflation reflects a judgment that aggregate demand remains above the economy's supply capacity, evidenced by persistence of underlying inflation, survey of business condition, and ongoing strength in the labor market. Growth in the output has been weak, past declines in real disposable incomes and the ongoing effect of restrictive financial conditions continue to weigh on household consumption, particularly discretionary consumption. Obviously, if you look at GDP, you can see that the economy is slowing down because different interest rates have been held at a higher rate or a higher level, essentially. Then they say, however, growth in aggregate consumer demand, which includes spending by temporary residents such as students and tourists, has remained more resilient. A range of indicators suggest that the labor market conditions remain tight. And if, like I said, if you're not familiar with the relationships, watch the video that I suggested. But you should know by this that if inflation is high, or if inflation is not budging and falling, and unemployment is essentially low, or the labor market is tight, then that's just a cycle, a virtuous cycle that feeds off itself, right? So we need to see unemployment go higher or the labor market not remaining tight for inflation or for us to expect inflation to start falling as well. So by them also saying this, they're telling us that they foresee that it's going to take some time for inflation to fall. And while conditions have been easing gradually, some indicators have recently stabilized. Employment grew strongly over the 3 months to September by an average of 0.4% per month. The unemployment rate was 4.1% in September, up from the trough of 3.5% in late 2022. But the participation rate remains at record highs. Vacancies are still elevated and average hours worked have stabilized. So all of these things essentially are pointing towards a fairly, not obviously in the best of positions, but a fairly good labor market. At the same time, some cyclical measures of the labor market, including youth unemployment and underemployment, have recently declined. Wage pressures have eased somewhat, but labor productivity is still only at 2016 levels, despite the pickup over the past year, right? Then they continue to say, labor market. They continue to talk about the labor market. Okay, so now I wanted to go strictly to inflation, right? Okay, let's read this last paragraph here. There remains a high level of uncertainty about the outlook abroad. Most central banks have eased monetary policy. Okay, they're talking about global economy there. So let's read this part here. Sustainably returning inflation to target within a reasonable time frame remains the board's highest priority. Obviously, they're telling you, right? So you don't have to guess, or you get the clues from the central bank. You may not get all the answers from the central bank because after this you then need to look at the data. What is the data saying? But you get clues from the central bank, and they are telling you returning inflation to their target in a reasonable time frame is their highest priority. So if inflation does not budge, then it means that it is going against their goals or objectives. This is consistent with the RBA's mandate for price stability and full employment. To date, longer-term inflation expectations have been consistent with the inflation target, and it's important that this remains the case. While headline inflation has declined substantially and will remain lower for a time, underlying inflation is more indicative of inflation momentum, and it remains too high. They're telling you guys, right? And if they say it remains too high, then why would they cut interest rates if they also going to say that underlying inflation is indicative of inflation momentum, number one, then secondly, it remains too high, right? Then thirdly, they say the November statement of monetary policy forecasts suggests that it will be some time yet before inflation is sustainably in the target range and approaching the midpoint. This reinforces the need to remain vigilant to upside risks to inflation, and the board is not ruling anything in or out. Policy will need to be sufficiently restrictive until the board is confident that inflation is moving sustainably towards the target range. The board will continue to rely upon the data and the evolving assessment of risks to guide its decisions. In doing so, it will pay close attention to developments in the global economy and financial markets, trends in domestic demand, and the outlook for inflation and the labor market. The board remains resolute in its determination to return inflation to target and will do what is necessary to achieve that outcome. So, as you can clearly see, I don't know if it's me, but this is pretty straightforward. Because they obviously raising their concerns about inflation being too high. Why? Because that is what they said. It is underlying inflation is more indicative of inflation momentum, and it remains too high, which is obviously not a positive thing if you're a central bank that is looking to lower interest rates at some point. But that also means that you're not going to look to lower interest rates if you're seeing inflation momentum and also it remaining too high, essentially, right? So pretty simple, straightforward case from the Reserve Bank of Australia. We're not expecting them to lower interest rates anytime soon. And they also, based on what they're saying, they expect a very slow decline or disinflation trend when it comes to inflation, right? So that is pretty straightforward, which means that we're not expecting them to lower interest rates anytime soon. And like I said, if you understand the relationship between inflation and interest rates, if we're not expecting the Reserve or anticipating or expecting that the Reserve Bank of Australia is going to lower interest rates anytime soon, what does that tell us? That we should look to buy the Australian dollar, because that means that they will remain more hawkish, and it also means that what? Possibly if inflation starts to reaccelerate, they could look to maybe hike again. Because what did they say? They said this reinforces the need to remain vigilant to upside risks to inflation, and the board is not ruling anything in or the board is not ruling anything in or out. That is essentially what they're saying. They're not ruling anything in or anything out. So there is a possibility they hike interest rates if inflation reaccelerates, or there is a possibility that they cut interest rates aggressively if inflation starts to do what? To decelerate or to fall aggressively, right? Or at a faster pace. This is what I mean when I say you need to start with the central bank statement, because this is the foundation so that you can make or get to that point of making crazy money trading part-time. Now we're going to read the Reserve Bank of New Zealand statement on the other hand. So it's pretty clear when it comes to the Australian side. Now, when it comes to New Zealand, they said the Monetary Policy Committee today agreed to cut the official rate or the official cash rate OCR to 4.75%. The committee assessed that annual consumer price inflation, obviously CPI, is within its 1 to 3% inflation target range and converging on the 2% midpoint. So you can clearly see they in different time periods or different spectrums in terms of their interest rate cycle. One is cutting interest rates because inflation, what? Because they say CPI is within the 1 to 3% inflation target range and it is converging towards the 2% midpoint. On the other hand, Reserve Bank of Australia, they're only seeing inflation reach the midpoint in 2026. So you can clearly see that there is some form of a divergence there, right? Then economic activity in New Zealand is subdued, in part due to restrictive monetary policy, which means that higher interest rates, because they kept obviously interest rates higher for a very long period of time, it is subduing what? Economic activity. Business investment and consumer spending have been weak and employment conditions continue to soften. Not even listen, but pay attention to what they say. They say, and employment conditions continue to soften, right? Low productivity growth is also constraining activity. What did the Reserve Bank of Australia say? Labor market is tight. Then some exporters have benefited from improved export prices. However, global economic growth remains below trend. The outlook for the US and China is for growth to slow, while geopolitical tensions remain a significant headwind for world economic activity. The New Zealand economy is now in a position of excess capacity, encouraging price and wage setting to adjust to a low inflation economy. Lower import prices have assisted the disinflation. So you can clearly see the tone is very different. Reserve Bank of New Zealand, they're talking about what? Disinflation trend, low inflation economy. That is not the story that the Bank of Australia was actually narrating to us, right? Or telling us. Then they say the committee agreed that it is appropriate to cut the OCR, which is interest rates, by 50 basis points, which is 0.5%, to achieve and maintain low and stable inflation, while seeking to avoid unnecessary instability in output, employment, interest rates, and exchange rate. So you can clearly see that in this regard, there's a clear divergence between these two economies. I don't even have to continue reading the full statement, but there's a clear divergence between these two economies, right? So let us just highlight a couple of things. So let's jump quickly to members. Okay, this is talking about global economic activity. So let's actually focus on New Zealand economy. Members agreed that increasing excess capacity is leading to lower inflationary pressures in the New Zealand economy. Economic growth is weak, in part because of low productivity growth, but mostly due to weak consumer spending and business investment. High frequency indicators point to continued subdued growth in the near term. Some exporting businesses have been supported by higher export prices, particularly in the dairy industry. Obviously, we know New Zealand economy is an agricultural based economy in terms of their exports. Then they continue to say labor market conditions are expected to ease further, with filled jobs and advertised vacancy rates continuing to decline. More generally, weak house price growth, lower levels of net immigration, and ongoing fiscal consolidation from spending restraint are expected to constrain aggregate demand growth. The committee noted that while wholesale and bank interest rates have declined, financial conditions remain restrictive and credit demand remains subdued. The current preference for short-term mortgage rates by borrowers will increase the speed with which changes in the OCR influence household cash flows over the coming months. Then, what did they say about inflation? The committee agreed that monthly price indices signal a continued decline in consumer price inflation in New Zealand. Recent business visits suggest that weak demand is restricting the pass-through of increased input costs to prices faced by consumers. This is consistent with business surveys, which show a declining share of businesses intending to increase prices. Remember, inflation is just prices going up. So what is this telling us? It is showing what? A declining share of businesses intending to increase prices. So most businesses are not intending to increase prices, obviously, because they're not getting any customers right now, because customers are what? Are feeling the high pressure of, or the high pressure essentially of what? Of restrictive conditions, because that is what they said, right? That is essentially what they said, because they said financial conditions remain restrictive, right? Like I said, this is the work that most people are unwilling to do. But here's the thing. We don't have central bank meetings every single day or every single week. You just need to read this once, understand it, interpret it better, and then allow your trading to work part-time for you, right? That's all you need to do, guys. Nothing overcomplicated about this. Then, this is consistent. Okay, then business price setting behavior is now more consistent with the committee's inflation remit. Essentially inflation objectives, right? The committee assesses headline consumer or headline CPI to be within its 1 to 3% target band in September 2024 quarter and to remain around the midpoint in the medium term. Obviously, that is what happened with what? That is what happened with the actual inflation. It fell to within the target band. Now we have core inflation within the target range, and we also have headline inflation within the target range. And it's not what we have in Australia. Australia, we have core inflation. Like I said, it's one that I prefer to focus on the most, sitting at 3.5%. Right? So we can clearly see that there is a divergence between these two economies. Then we also look at they're considering global and domestic risks. So let's read the final closing or conclusions. The committee agreed that the economic environment provided scope to further ease the level of monetary policy restrictiveness consistent with its mandate of low and stable inflation. The committee discussed the respective benefits of a 25 basis point versus a 50 basis point cut in the interest rates. They agreed that a 50 basis point, which is a bigger jumbo cut, at this time is most consistent with the committee's mandate of maintaining low and stable inflation while seeking to avoid unnecessary instability in output, employment, interest rates, and the exchange rate. The committee noted that current short-term market pricing is consistent with this decision. The committee acknowledged that the outlook is broadly consistent with the August monetary policy statement. Members agreed that an official cash rate of 4.75% is still restrictive, which means that current interest rates are currently still restrictive. So what does that tell you? They are more than likely going to continue to lower interest rates, because what have they been saying in the previous paragraphs? That consumer spending is very low, economic activity is weak. So obviously, if they then also say that interest rates at 4.75% are still restrictive and leave monetary policy well placed to deal with any near-term surprises, that tells us that if inflation continues to fall and there's no near-term surprise of a spike high in inflation, then they're going to continue lowering interest rates. You can clearly see the divergence between these two economies, and that is what I want to point out to you when it comes to actually making crazy money while you're trading part-time. Because you do this once. This is what I did, right? Obviously, I've been tracking this every single time we have an interest rate decision from a central bank, but this is the first step. This is the first step to actually making what? Crazy money trading part-time. Then they continue to say the committee confirmed that future changes to interest rates would depend on its evolving assessment of the economy. So what evolving assessment of the economy? What does that include? Inflation, the actual economy, and then obviously the labor market. If unemployment continues to increase, of which is what we saw, that unemployment actually went higher in New Zealand. So all of those things are pointing towards what? Towards further interest rate cuts. Now, it might be a question of whether it will be another 50 basis point or another 25 basis point. Yes, it makes a difference, but the primary conclusion you can come to right now is that we do expect what? More interest rate cuts from the Reserve Bank of New Zealand, right? So you can clearly see how the two central banks are essentially are moving in opposite directions. Now, once you are clear on this, then all you have to do to obviously trade part-time and make crazy money is then revert back to your technical analysis. And now when it comes to technical analysis, you're just sticking to the primary basics of technical analysis, which is buy low, sell high. You're looking to buy Australia against New Zealand dollar, so look to buy low and sell high. What does that mean? Wait for price to drop and then you buy. Where do you buy? It's up to you in terms of what technical analysis strategy you use. If you use support and resistance, identify a level of support and resistance. If you use supply and demand, identify a level of supply and demand. If you use, let me just plot some moving averages here on the chart. If you use moving average, then I also have okay, this is much more of a longer term one, but you can clearly see you can also have used moving average and be like, okay, they both pointing upwards. The shorter term one is above the longer term one. Okay, that means that we are in an uptrend as well, which is a confirmation of what I got from fundamentals. But whatever strategy that technical analysis strategy that you use is not as important as understanding what the captain is thinking about, what the captain is focusing on, because that is the primary purpose of reading the central bank statements like I just showed you in the past, essentially most part of this video, right? And like I said, that is the work that most people are unwilling to do, and that is why most people aren't really making crazy money trading part-time, because they are unwilling to do the necessary work that's actually going to make your trading work for you, rather than you being a slave to the market. Because like I said, I had to open these positions once, and then all I have to do moving forward is just keep on reading articles. Keep tracking inflation data for New Zealand, inflation data for Australia, GDP data, unemployment data, all of those macroeconomic indicators. And then as long as they're pointing still supportive of what the central bank said, then I just hold my positions. And that is how you make crazy money trading part-time, right? So if you found value from this video, I know you're definitely going to like the next video that's going to pop up on the screen. So do watch that video, and obviously do subscribe, and also share this video with someone who you feel might